Welcome to Shivakumar classes. Today the topic which I am going to explain is marginal costing. So today the very interesting topic which I am going to explain, but it is going to be a little lengthy video because in this topic we are going to cover the meaning of marginal costing, the meaning of break-even point, and the calculation of profit, and after that we are going to see the various formulas. BEP in terms of units, BEP in terms of rupees, we have two different formulas. PV ratio we have 2 to 3 different formulas. Contribution we have two different formulas. Margin of safety two different formulas, and formulas under expectation of profit we have two different formulas. If we want to explain all these formulas, it will be the lengthy video. So without skipping any videos, have little patience and see that one so that you can understand the entire chapter. It is full and fully into this single video. Yes, what is this marginal costing? So very in simple meaning, if I want to say, it is that additional cost incurred for additional production. Additional cost incurred for additional production. That means that another simple meaning is that extra cost incurred for extra production. For example, already I produced 10 units. Now I want to produce 5 units extra. How much cost it will be incurred for production of the 5 units extra? That is called as the marginal costing. Next we are going to discuss here, it is the most important topic relating to this chapter. It is the break-even point. What is that break-even point? So break-even point means that no profit and no loss. No profit and no loss, or the revenue is equals cost. In a manufacturing unit, my manufacturing and sales, the cost of manufacturing and cost of sales is equals, so that it does not incur any loss and there is no any profit. The very first topic which relating to calculation is around 5-step calculation. Let me do it here. This 5-step calculation only will make you to remember the various formulas. Let us assume that my sales is 200 units at the rate of rupees 1000. 200 units at the rate of 1000. So that I expect my sales will be 2 lakhs rupees. Less variable cost. Let us assume that 600 rupees is my variable cost. For the 200 units it is 1,20,000 rupees. The balancing figure what I get is rupees 80,000 is called as contribution. From that contribution less fixed cost rupees 50,000, and the remaining balance I get 30,000. It is called as profit. One small calculation I have given. Based on this small calculation only, let us discuss the various formulas. Now before going to that, there is a shop in a market. That shop is consisting of manufacturing and selling of some of the snacks items. Assuming to be he sells 1 unit at 5 rupees. Every day rent it is 200 rupees and 250 rupees he is paying. That rent what he pay, it is called as the fixed cost. And the ingredients of manufacturing of that snacks, it is 750 rupees he spends. So overall in terms of cash he spends 1000 rupees. So when he sells for 1000 rupees, 1000 divided by 5 rupees. So 1000 rupees divided by 5 rupees is 200 units. So every day if he sells 200 units, then he will incur that 1000 rupees cost. He will earn that 200 rupees. He will collect that 200 rupees. Sorry, 1000 rupees when he sells the 200 units. So minimum 200 units he need to sells. When he sells for 200 units, then there is no profit and there is no loss. Break even point in terms of units. The formula is total the total fixed cost divided by contribution per unit. Total fixed cost divided by contribution per unit. Total fixed cost divided by contribution per unit. Yes. Let us see that how we got that contribution. The contribution has been arrived after minusing the variable cost from the sales. Therefore, contribution is equals sales minus variable cost. My sales is 1000 rupees per unit and my variable cost is 600 per unit. 1000 minus 600 is 400. Contribution is equals 400. Therefore, my fixed cost given in a question is 50,000. Yes, 50,000. Out of 50,000 is fixed cost. 400 rupees is the variable cost. 2020 gets cancelled. Therefore, BP is equals 125 units. 125 units. Now what you do, just multiply this 125 units into 1000 rupees. If you multiply that, 1,25,000 rupees will be the BP in rupees you will get. The second formula which we are going to discuss here, it is BP in rupees. We have two different formulas. The very first formula we have, it is BP in rupees. BP in rupees is equals total fixed cost divided by total contribution. Total contribution into total sales. Total sales. So total fixed cost we have 50,000 and total contribution we have 80,000. 80,000 into total sales is 2 lakhs rupees. So therefore 4040 cancel. So 1,25,000 rupees you get the total sales. 50,000 into 2 lakhs divided by 80,000 is equals 1,25,000. Yes. Now we got the BEP sales in rupees. And we have one more formula for BEP. BEP is equals total fixed cost divided by PV ratio. This is the third formula which I am explaining now. What is this PV ratio? The PV ratio means that profitability volume. PV ratio is equals profitability volume. PV ratio is equals profitability volume. That is, what is the percentage of profit? The profit will be measured in terms of the percentage. Yes. What is the formula for PV ratio? PV ratio is equals contribution divided by sales into 100. Now my contribution is 400 rupees. My sales is 1000 rupees. That will be converted in terms of percentage. 0, 0 gets cancelled. Therefore, you get 40%. 40% will be written as 0.4. 40 divided by 100, it is 0.4. Next, we have one more formula for the PV ratio. For that another formula of PV ratio, then we require the information like this. Sales, for example, in two different period it is given 2 lakh and 2,50,000 sales, and profit for one period it is 30,000, for another period it is 50,000. For example, this is in 2020 and 2021. Now you see that the sales of two different period and profit of two different period is given. So definitely there is a change in sales and there is a change in profit. How much is the change in sales? It is, the change in sales is 50,000 rupees and the change in profit is 20,000 rupees. Based on this only the formula is going to appear. The formula is change in profit divided by change in sales. Change in profit is, we have 20,000 divided by change in sales is 50,000 into 100. Again the calculation is that 40%. So I have given two formulas of the PV ratio. One formula, it is the change in profit divided by sales. Another one is contribution divided by sales into 100. Yes, these two things it is. Now, the next topic which we are going to discuss here, it is now BEP, PV ratio over. Next one is the contribution. Contribution, we have two different formula. One, it is selling price minus variable cost is the contribution, and from the contribution and the formula which I have shown, from the contribution we minus the fixed cost, therefore we get what? Profit. So my contribution is 80,000. How I got this 80,000? 20,000 minus 2 lakh minus 1,20,000. I get 80,000. Next one, you see we have another concept, fixed cost and profit joined together, you get the contribution. Fixed cost 50,000 and profit is 30,000. Therefore, the another formula also we have for this, fixed cost plus profit. Then also you get the same 80,000. You see that 50,000 plus 30,000 is equals 80,000, and the selling price it was there, it is how much, 2 lakhs, minus variable cost 1,20,000. Then also you get the same 80,000. So two different formula we have, it is for contribution. Okay, after this what is the next topic we are going to discuss is, after that contribution we are going to discuss it is margin of safety. What is the formula for margin of safety? The margin of safety, in short it will be written as MOS, margin of safety. What is this margin of safety? Margin of safety is equals actual sales minus BEP sales. We have two different formulas. Let us see the answer in two different formulas. It is going to be same. The actual sales in a problem I calculated is the 2 lakhs, and BEP sales we have calculated is 1,25,000. So the answer which I got is 75,000. This is what margin of safety. The same thing will be calculated with the another alternative formula. Margin of safety is equals profit divided by PV ratio. My profit I got is 30,000. The profit I got here, it is 30,000. Yes, profit 30,000. And my PV ratio I got, it is 0.4. So 30,000 divided by 0.4. 30,000 divided by 0.4 is equals same 75,000 is going to be the margin of safety. 75,000. Yes, margin of safety also it is over two different formula of margin of safety over. And next it is the formula under expected profit. It means that I am going to expect some profit into my business. If I want to achieve that much profit, what should be my sales? That sales will be calculated in terms of units. That sales will be calculated in terms of rupees. So we are going to apply two different formulas here. One it is that will be call it as the desired sales with desired profit. Desired sales with desired profit. So desired sale means that expected sales, and desired profit means that expected profit. So what is that sales? It should be, that is will be in terms of units, one formula will be given, and in terms of rupees one formula is given. So very simple to remember, that one is units. I want the sales in terms of units means apply the BEP in units formula. BEP in units is that total fixed cost divided by contribution per unit. With this, what is my desired profit? My desired profit, for example, I want 50,000 rupees is the profit. Old it was 30,000, now I expect it is 50,000. When my my profit want to be 50,000, how many units I have to sell it? Very simple. My fixed cost is 50,000 and my expected profit is 50,000, and my contribution per unit is 400 rupees, which is well known that. Therefore 1 lakh rupees divided by 400 units, contribution per unit is 400. So 1 lakh divided by 400 is equals. So I have to sell 250 units. If I sell 250 units, I will get a profit of 50,000 rupees. Let us check it over immediately. Yes, come on. Sales expecting to be 250 units into 1000 per unit, 2,50,000 rupees. Good. Next one is variable cost, 250 into 600, 250 into 600 is equals 1,50,000, 1,50,000. Therefore definitely my contribution changes. My contribution, I get 1 lakh rupees. We know very well that my fixed cost is equals 50,000. 1 lakh minus 50,000, remaining 50,000 is profit. Now you see the sales, I need to do it for 2,50,000. Now the next formula which I am going to explain is that expected is 50,000 profit. What should be the sales in rupees? For that, what is the formula you have to apply? BEP in terms of rupees. BEP in terms of rupees, what is the formula? Total fixed cost divided by PV ratio plus expected profit. My expected profit is 50,000. Expected profit is 50,000. My fixed cost is 50,000. My expected profit is 50,000 divided by my PV ratio is 0.4. Therefore, 1 lakh divided by 0.4 is equals 1 lakh divided by 0.4 is equals 2,50,000. 2,50,000. That is in terms of rupees. So now once again all the formula, let me give it into the one by one. Very first one is BP in units. BP in units. First formula it is total fixed cost divided by contribution per unit. Contribution per unit is equal selling price minus variable cost. Second one is the BP in rupees. For the total fixed cost divided by total contribution. Total contribution into total sales. Total sales. Third one is the same BP in terms of rupees. Total fixed cost divided by PV ratio. So therefore we indicate the formula of PV ratio. PV ratio is equals contribution divided by sales into 100. Or another formula for the PV ratio, it is change in profit divided by change in sales in change in profit divided by change in sales into 100. Change in profit divided by change in sales into 100. This is the formula for PV ratio. Next one is the margin of safety. It is actual sales minus B